I launched an online furniture company from 0 to 3 million over a 2-year period. I've now got to go for an interview, and it was tough.
But how did you swallow your pride? How did you position yourself as employable?
It was a pretty brutal time, to be honest. I always had this stigma in my mind that sales wasn't really a career that you should follow.
Hey everyone, welcome back to $100 Million Exits. Today we have James Rose on the show, who is the CEO and founder of Inflectiv Group, a platform and holding company for acquiring marketing and communications companies. James, welcome to the show.
Hey, Jason, great to be on. Thank you.
So, James, I want to start with kind of your first business and the story that kind of really helped shape you into what you do today. It was kind of a classic boom and bust story. Tell us a little bit about what that business was doing and kind of how that shaped you ultimately.
Yeah, absolutely. So I left university and got a grant to basically fund a new business. And at the time, there was a significant foreign investment into Bulgaria, about 20 billion over a 5-year period. And so I went out to Bulgaria, and what was really interesting was about 50% of that investment was going into property-related services. So off-plan developments, land acquisitions, commercial projects. And I bought a small apartment to kind of get on the property ladder over there, and realized there was no furniture companies that spoke English. Literally, it was impossible to furnish an apartment. And obviously with hundreds of thousands of units being built, it was an opportunistic time to get into the market. So I launched an online furniture company. I was fortunate to find a local business partner to manage suppliers and staff, which was critical really over there. But yeah, it was a classic. We grew really quickly, turned on an ad campaign on Google, and literally the phone started ringing, and grew, from sort of 0 to 3 million over a 2-year period. And just thought everything was easy, to be honest. First business, this is all sailing. Spent 6 months of the year out in Bulgaria, we had a really good run of things for about 4 or 5 years, and extended into other areas. So we started acquiring land. We were planning an off-plan development next to a Gary Player golf course, and we had a property brokerage business. And so we were extremely overexposed to the global financial crisis, obviously 2008 to 2010. It was a huge learning curve. So going from a kind of fast start like that, never having run a business before, to then going into a huge decline very quickly, like literally 80% drop in a year in terms of sales. We had to respond to that. And my response at the time was to get creative and to continue pushing. I never knew that an economic crisis would last, 5 years or more, and that credit would become impossible to obtain. And so, you had all these off-plan properties that people had put deposits into, and they were just throwing the keys back. They didn't want to furnish them. They didn't want to, even finish the purchase. And so we pivoted. We went to Russia, where there was still some demand. We went and did an exhibition in Moscow, and through luck, really, we managed to meet somebody who's quite influential. We set up a network of sub-agents throughout Russia and Ukraine. And instead of building our own development, which we were just launching at the event, we had to kind of pull back on that. So we took deposits from clients for off-plan development. Our funders got pulled because obviously there's no development finance. We were overextended. We had, salaries to pay for. Revenue was dropping, and it was a pretty brutal time, to be honest, to go through that, having felt that everything was easy and then running into those roadblocks. And so it was probably like 2.5-year period of trying to push against that before I realized that this just isn't going to work. The market's finished. It's going to be a long time before it comes back. And I'm glad we put things on hold. We didn't have any disasters where we actually got land repossessed or developments collapsed or anything like that. But I had to come back to the UK. I was getting married at the time, and I had to get a job essentially. And I think that was the biggest pill to swallow, was having 7 or 8 years of entrepreneurship to think, right, I've now got to go for an interview. And it was tough. When people look at a CV and all you've done is your own business, that actually you're a high risk. You're a flight risk as well. How's this guy going to fit in? Is he really going to be told what to do? So it was definitely a sobering part of my career, I had to kind of swallow my pride and just knuckle down. And I was fortunate to join a really high growth digital marketing business and got into sales and ended up doing well there. But yeah,
Actually,
it takes its toll.
James, if you don't
Yeah,
mind,
sorry.
I kind of want to talk about that transition
Yeah.
because I talked to a lot of founders, and not all of them become massive successes where they make millions of dollars and they can then do whatever they want. Some run into challenges like yourself where the business didn't become what they expected it to be, and they're faced with that dilemma. Do I try to swing again and, do another startup and, be 2 years of living on ramen kind of thing? Or do I get a job? And for those that maybe married and or have kids, the job is often the path that must be chosen. So I'm kind of curious, like, you kind of brush it off a little, oh, yeah, swallow your pride, but like, how did you swallow your pride? Like, how did you position yourself as employable?
So, well, firstly, it was through necessity. We were. I had a huge overdraft, a business overdraft that we now couldn't service very easily. We had commitments. So the idea of a new business was just kind of felt. It felt like we'd done everything we can in the area that we knew. And the market that we knew, and so it was literally just looking for any kind of. I mean, I think I naturally started quite high. I was applying for jobs that I thought, I would easily get, and obviously got no response whatsoever. It's like, you've got no management experience, you've got no whatever. So, I think sales is one of those paths which actually can open up success for anybody. You can learn it, you can be coached, you can overcome resilience, and so I was just fortunate that they took a chance on me. They were growing really quickly. And I think they could see that it was either going to work or it wasn't. And you kind of get a month. You only get a month to prove yourself, right, in sales. So it's not like you get a very long runway. But yeah, it was just putting the CV together, trying to make it as agnostic as possible, and not just like some Bulgarian expat who's trying to pivot his career.
And so, when it came to like the jobs that you shot for, like were those like VP, director level type jobs of bigger companies? Like, what were the jobs that got denied?
Not quite that high. I mean, I was looking regionally, so where I was based. So I wasn't at the time willing to kind of have a massive commute into London and things, which I did later in my career. So the circle of kind of opportunities was within like a 20-mile radius of where I was, and it was kind of mid-management level roles initially that I was applying for in companies that I thought were of a significant size, but I was kind of still led to smaller businesses. I didn't apply for any big conglomerates. Like I couldn't see myself going to work at like an Experian or a bank. That was never going to happen. So it was like, who are these kind of SMEs that actually at the time I still thought I could bring a lot of value to through my experiences. But what I found was that they didn't value any of that experience. They were hiring people that had done 7 or 8 years in a similar career, essentially.
Yeah, so it's a painful pill to swallow. And yeah, you built a multi-million-dollar business and managed it, and probably had tons of people that you were managing and sales contracts, all that kind of stuff, and basically start over. Your ladder. It's a pretty humbling experience. And I guess what kind of success did you see? Because it took you basically did sales and business development for years before kind of now taking a swing again at the founder role. So what was that journey?
Yes. So in that agency, I was fortunate to become one of the top tier like sales people in the business. Generated a lot of revenue for the company. Personally, was able to kind of get myself out of the hole that I'd created. Repay off like the business overdraft, start to get some stability. We had our first child, and so I was just super motivated. Once I saw that actually this was a no capped bonus structure and people were earning very high 6-figure salaries, I was like, actually, this isn't as bad as I thought it was going to be. But it was really tough. Like, it was, 150 calls on a Monday, sit 8 meetings all week, go and try and close a small business on a search campaign. It was tough, but I learned actually a lot of resilience, and I actually started to learn how to sell. And overcame my personal resilience with sales, because I always had this stigma in my mind that sales was like wasn't really a career that you should follow. It's like you're taking money from people. You're kind of like, it's all these kind of psychology, etc. But once you realize you're solving problems and you've got happy customers that you're doing a good job for, that then started to become exciting for me. So from there, I did quite well, and then wanted to get into an early stage company. I wanted to start to get some equity, which was obviously the original play with my own companies. Was I'd kind of been taught from an early age that you have to be a shareholder to really make some money. And so I joined a fintech business. Wasn't able to get equity, left after 2 years, and then was fortunate to join an early stage video tech business. And we were about 5 or 6 people at the time, and then we grew over a 7-year period. And I was given the opportunity to move into sales leadership and expand within that business as the business grew, which is, I think, is what I wanted. In a tradition, in the sales role I was in originally, the opportunities. Actually, the people earning the most money were the individual contributors, and I felt a little bit capped by that. I wanted to kind of develop my career and be exposed to more than just sales. How can you actually really scale a company? So that was as you say, like over 10, 15 years of my career in those sales and sales leadership roles, which was good. But yeah, where we are now, obviously, I've kind of pivoted to M&A and trying to build value in different ways. But it was an enjoyable part of my career.
So yeah, let's kind of transition to that narrative. Like how, I guess, why? Did you kind of say like, okay, I've had enough of the corporate journey. I got the bug to go back and do something on my own, and then why roll-ups?
Yeah, so there's a couple of steps for me. One, the equity play within the startup didn't materialize. So I could see that actually this was, I'd been there 7 years. This was when I left. I thought there's going to be another 5 years before any kind of capital event, just the path that business was on. So that was a bit of a wake up call that, you can dedicate your time and effort to a company, and not going to pay off at the end of it, should we say, which meant that I had to revisit my plans, that if I wanted to do bigger things, that I had to find a new model. I also could see this dichotomy between kind of bootstrap businesses and well-funded businesses. So when I left that video tech business, I did some fractional work. Was my first step. Was like, how do I just get exposure to more businesses? So I was doing 2 days a week fractional. I was being put into high growth companies that had some aggressive targets to meet. Usually they had some go-to-market problems that I'd come in and solve. And I was just exposed to a whole diverse range of businesses. Some had raised, some who hadn't. And I thought, geez, this is still a really long path. Most of these companies are 3 years in. They've probably got another 7 or 8 or maybe more before the founders are going to have some sort of exit event. How do we kind of shorten that time frame? And that led me to looking at the M&A market. And particularly in the agency space, I could see a lot of change happening. The big groups, the big holding groups that had been acquiring revenue for decades were under pressure. There was talent leaving those holding groups and going to independents. Shareholder value was dropping. Yet there was thousands of agencies that were really well run, profitable businesses that have been trading for 20 years. And so when I looked at that landscape, I thought, well, how can we roll up independent agencies, but make it a really good outcome for the founders? So how do we de-risk some of the pitfalls of the execution risk that comes with rising big amounts of capital? Because I'd seen that has its risks, whether it be the technology, whether it be the people. It's never a dead cert. And so the model that we landed on was, how do we take a minority position, so we don't have to deploy lots of capital, we don't have to come in and run these businesses, but through a holding group structure, we can actually increase shareholder value much quicker. So, our model is to be like the final 2 to 3 years for the founder, where they've already done the hard work, they've proved resilience, they've proved market cycles, they're cash flowing, but they're still, unfortunately, valued as an independent subscale business. And so by us achieving scale, we then attract capital that will take our group to the next stage. And that's what private equity are looking for. That kind of 50 million plus enterprise value. There's a lot of capital waiting to be deployed because it's less risky than coming into an early stage venture. From my personal obviously experiences, so it was multiple steps to that realization, and then it took a long time it took about 12 months of deals falling over before we actually got into our first agency, and which was February last year. But it's a journey, like with any founder's journey. You learn along the way. You don't have it figured out from day one, and we've had to make a lot of changes to the vision, to the terms, and kind of keep adapting.
Let's talk about this market. A lot of people are thinking, technology companies, and that's where everything's at. And there's been a pretty sharp shift towards real business, we'll call it. Cash flow, revenue, profit, mainly because, in my opinion, the venture market grossly overfunded a lot of businesses. And, I think one of your businesses in the past, Wuxi, I think it was called, raised 10 million, but it was effectively a service company. It's like, what was a service company, a managed service company raising venture capital or, private equity at that level? And a lot of these companies got grossly overfunded. And, I respect the angle that you're taking with your, kind of new roll up and, platform company of, buying real businesses, because that's been a general theme that's coming up more and more. We're actually working with a couple of tech companies to go buy real companies because, they have tech that these customers won't buy because it effectively depletes their, it eliminates their job. Yeah. So, just some insight for our audience on kind of deals that we're structuring now, and kind of curious to get your thoughts on it. We have tech companies that are in market that try to sell like a per seat basis software for like a couple $100 a month kind of thing, and they struggle to sell it. And when we did a deep dive audit, we identified that they had a product that effectively eliminates the buyer. So the buyer buys it, and then their job is reduced to about 10% of its original workload, because the software does 90% of the work. And obviously writing on the wall, like, I buy the software, then what good am I?
Yeah.
Like, well, you better be the first one to use it the best.
Yeah.
And what we identified was like, well, acquiring the venture capital market was not interested in their business anymore, for a variety of reasons. That's what we identified is like they have a hurdle they have to hit. They want to get to about a $50 million plus valuation, and they're nowhere near that right now in terms of real life comps. And so what we identify is like if they go out and buy $5-10 million revenue agencies that are doing maybe 15% EBITDA, 10% EBITDA, they could eliminate a lot of the overhead with their software, consolidate, have efficiencies, and get closer to like a 30 to 50% EBITDA effectively with that revenue after like a year of transition. And those are the types of companies that we're going out and buying on their behalf. So they're becoming a tech-enabled service provider. So their multiples won't be, 20, 30x revenue or anything stupid like that, but they could get 10x EBITDA in these situations. So I'm curious to kind of hear your thoughts as you're in market and, looking to buy companies. How do you guys evaluate, do you guys have tech and is that a piece of it? Or is it you're just kind of coming in and the blocking and tackling of consolidating, service businesses? How do you think about it? Real quick, if you're a founder doing over $5 million in revenue and want to know what the best $100 million plus founders are doing to fuel their growth, then make sure to subscribe to our $100 million Exits newsletter. Get the playbooks that are proven on how to fund, grow, and sell your business. I'll even give you a curated list of investors that want to invest in your business. It's totally free. All you have to do is click that link down below. Subscribe, do it now. I promise it's worth it. You won't regret it. You got nothing to lose. Go ahead, subscribe now. Back to the show.
Really good, interesting topic. So originally, our vision was to have a tech-enabled platform, still to do the minority, not the full acquisitions that you just described, but to have some kind of tech-enabled layer around the group. Right now, that is still to be decided, if I'm honest. There is pros and cons to both. We've looked at partnerships in the tech space. We've looked at AI development, like how can we instill agents at a group level that drive efficiencies. And if I'm honest with you, where we are right now is we feel that we want to leave some value on the table. And coming back to that kind of execution risk, like we've not done this before. We this is our first group we're building. We've got fairly modest expectations of size and shape. And so we feel quite happy to let the acquirer do some of that tech enablement as the next stage, rather than us take ownership of that. But there is 100% a huge opportunity there, and across so many markets. Because as you say, they've got the tech already. They already own that. They've got, they've funded it however they have. So they've got the platform. I think what's different for us is we don't have the platform. So it's like we either have to acquire it, partner with, or bring that in some other way. And that just is a slightly different time frame and different level of capital than we're looking at right now. So and it's amazing. I've spoke to a number of founders actually that have had a similar realization on the funding side. So like tech, for example, a tech social agency I spoke to recently who have struggled to continue on the tech path, but are now developing a managed service, not only because of the funding, they're sort of subscale and still early stage, but also on the brand side. So we're seeing that brands now are kind of coming a full 360 and saying, well, it's great that you've got some tech, but what we want the people servicing us. We want that full wraparound managed service. And I think that's where some models have gone a bit too tech enabled and missed the people part, potentially.
No, I want to keep talking about this because this is more and more what I'm seeing. Like even ourselves at Thunder, we consider ourselves a tech enabled investment bank. At the end of the day, everyone wants a transaction and get a deal done. But the only thing that gets a deal done is people. You have all the tech kind of in the background, streamlining, making things more efficient, faster models, models that produce, or financial models that produce faster, like competitive research, kind of like everything's getting faster and more efficient. But that's just like table stakes. That's like the bare minimum, that's required. And if you don't have that, your profit margins will be less and people, will overtake you. And so I think it's an absolute must for businesses to evolve into being more tech enabled. But the other day, it's like, you can't, as I see AI companies popping up left and right. We're like, the AI M&A banker. And like, all it really is doing is just cold emailing a bunch of, people. It's like, all right, it's a numbers game. It's like, not really. Because like when you want to, at least in my world, like if you want to do a transaction, like people just need to justify the time invested to get behind the idea of an acquisition. And they really only trust that if they conceptualize the idea themselves and went hunting for it, or the person they trust brought them the idea. And so it's so much still comes down to relationships. Another example is tech company here in the UK, like sales enablement, million sales enablement tools out there. And they chose a different route. Rather than raising tens of millions of dollars, raise a little bit of money, get some tech off the ground, but then they do the managed service. So they have like a managed service that's like 15 grand up front plus, some, kind of maintenance. And then they have a SaaS fee, which is like, $50 a seat. And so like the SaaS is there, but they're cash flowing and not going to have to go out and raise money and kind of compete with these other, the Gongs and HubSpot, these mega companies out there that have raised, tens of millions or hundreds of millions. And they're just going to have a great business, and there's edge there. Like people need help. Like, for setting these things up, like to expect your office manager to, set up your sales and, enablement is not really going to happen. So there's definitely a need for these managed services in the space. And it's a slightly different business model than what we've seen before that should hypothetically be higher margin, lower headcount. So one thing I want to kind of talk about is what you're seeing in terms of pricing these agencies. Everyone always wants to know, what am I worth? What's my valuation?
Yep.
And, for insights on the people here, it's like some of the major conglomerates, as you were alluding to, it's like, let's just put some out there like WPP and S4, Capital, in their heyday, 15 billion and 8 billion respectively in terms of valuation. But now are, 80% of that, 20% of that, or even 10% of that value. And they've completely fallen off a cliff in terms of market, comps and publicly traded comps. So I'm curious from your perspective, like, what are you seeing in terms of the valuation of these types of companies now, given that the market multiples have fallen off a cliff?
It's fascinating. I was actually looking at this a few months ago when I saw WPP's share price, because, as you say, these have taken a real beating over the past few years. And if you take an average of the public holding companies, they're trading at around 8 times EBITDA, roughly on average. Publicis has done well, mainly because I think the market views their tech enablement as a success. But you compare that to private markets, it's not unusual for a private agency that is a service-based business doing maybe $1.5 million of EBIT to get a 10x. As a tactical acquisition for a group, like that happens quite regularly. So you're seeing like higher multiples in private markets than the public markets, and that's fascinating for me because that's all. Every other market you look at is the opposite. You've got the liquidity in the private market, so you pay a premium for it. You've got the trust, you've got the governance. But I think that's an early signal that private equity and big funding is looking at the independent agency space, and they're seeing that it's bottoming out. And I think they're looking at value right now and coming into the market this year and next year, and looking to consolidate themselves and take these independents forward. I don't know the inner workings of any of the groups, to be honest, but anecdotally, like the number of layoffs that are forecast this year are in the tens of thousands, which is really sad for a lot of very talented people that have been in these businesses for a number of years. But that's just the way the market is right now. And
do you think that has anything to do with just like kind of even Anthropic CEO kind of had a manifesto that went out yesterday or the day before of, like watch out white collar jobs, in terms of like there's going to be mass layoffs, which is like marketing companies. And one of the first applications of AI agents is, marketing.
It's undeniable risk. I'd say we look at salary load, we look at cash flow, and some agencies are bloated, right? There's no denying it. We walk away from some opportunities where the founders propped up the agency with directors' loans just to not let people go. Yeah. Like it happens all the time. But we have to be a little bit more commercial about these decisions, and there is certain metrics that, So there's downward pressure on headcount, but we haven't seen any, like we've got 4 agencies now. We haven't seen any redundancies or layoffs, and actually we're hiring across most of them. So we're finding ways for those employees to be more productive. And we're staying true to the fact that brands want that personal relationship and skill. But yeah, it's changing all the time, and it's very hard to forecast what this next 2 years will look like. I think there's definitely a 5-year risk in this market where the state of the independent agency world could be very, very different. But right now we're sort of on the cusp of it, and we're trying to manage it fiscally with some governance.
I find it interesting to kind of see how agencies kind of navigate these headwinds, especially because I think, when we were talking offline in terms of your target, well, actually for the audience's purpose, like who do you want to buy? Like who's on your, kind of like what would you say are the attributes of the companies that you're looking to acquire?
Yeah, so there's some hard rules. So in terms of revenue and profit, so ideally a minimum of $500,000 of EBIT is a kind of baseline. 10 years of trading history or more, the longer the better. We're looking at UK, US, and Middle East, and looking to diversify revenue across those markets. So right now, we've only got one agency that has an office in the US. So we're actively looking for more agencies in the US so that when we exit as a group, we've got that geographic diversity. So there's kind of finance and tenure. We look at founder-led agencies that have started to make some paths with management team and succession. A lot of the agencies we speak to have already spoken to a number of different acquirers in the past, so they're quite up to speed with valuations and what they would be expecting in the open market. But beyond that, they have to be servicing global brands. They have to be kind of cash flow positive and put some discipline in those areas. And then we talk about the top 1%, and it's hard to quantify, but for me, it's actually the people in these businesses. I'll know very quickly when I speak to a founder whether I'm aligned with them or whether they're, and as we just described, these are people-based businesses, and relationships are really important. We're building this as a minority, so it's not like we're coming in to change the rules overnight. We're coming in to be aligned with those founders over a bigger exit in the future. So there's some soft things behind that in terms of like how they're managing the team, just understanding their journey, like what they've been through, why they built the business, what their expectations are, and that just comes out of conversation. So it's hard to have firm lines, but there's certain things that it makes sense for us in terms of the direction we're heading.
And when you think about founders that might be interested, so, to you or to anyone else that are running these service businesses, and there's two types in my opinion. There are the ones that have adopted technology and are rapidly scaling and have like real sales funnels, and then there's the others that had a real business and they are now kind of resting on their laurels, and they haven't really invested into the latest and greatest technology, and they're now kind of in this either on decline and or have declined, or they're kind of flatlining and not sure what to do. So for those in the latter position that are maybe kind of like, what do we do?
Yeah.
Like what's your advice to those founders that haven't really taken the action yet?
Yeah, I think first of all, take an internal review and survey your customers and your people, because if you're an established service-based business, what I've seen is that there's a very high chance that you are still targeting verticals and customer bases that were 5 years old now. You're not looked at any new markets, you've not reviewed your ICP, you've not developed a real commercial engine, and that gets you to a certain level. But times are changing, and whether you bring in a fractional person or a consultant, like you need to start really looking at the data. And I think founders avoid that sometimes. They can get quite complacent. It's hard to look at your business and say, well, actually, we need to pivot. But go to market and building the commercial engine is a common problem we see. They're just still targeting industries that they shouldn't be. I would say get a CFO. A lot of agencies, sub 5 million. I'm shocked how many don't have any CFO whatsoever, whether that be fractional or other. They have an accounting firm that's looking in the rearview mirror, and that's a problem. You have to have proper forward-looking guidance of where the business is going, because any acquirer is going to be looking at that, and if they want to get to a certain level of EBIT to achieve a certain multiple, it's impossible just looking historically. And so the CFO side of things is a common gap. And look at acquisitions. If you've got a solid business and you don't want to build a bigger sales team, you don't want to develop technology, look at some M&A activity. Maybe there's a competitor of yours that would be happy to merge with you, and you could kind of do a paper share transfer and double overnight. I think M&A is one of those topics where you can go very deep with it and you can pay a lot of money to consultants, but the best thing to do is just get out and speak to people. Don't get stuck in the education mode. Go out and have conversations with similar founders and say, hey, what's your plans? Where are you looking to get to the next 2 years? Could we do something together? I think that's a massive opportunity for founders, whether it's joining a group or just doing it themselves, really.
No, I would agree. I think too many people kind of get lost in their world of their own little silo and don't really have conversations, and then they're kind of misguided or very unaligned expectations of reality. I can't tell you how many times companies think they're worth way more than they actually think they are, and haven't really done the deep dive audit on themselves and or had someone else come in and audit them from a valuation perspective. That puts a lot of these founders in check. And that's something we do often with a lot of companies, is just kind of like show them like, hey, I know you think or thought you were worth X, but based on current comps and your revenue has still growing, but not as fast, or whatever these variables that come into play, They just see like, oh, my competitor raised $100 million, so I must be worth. No, those are, two different things, apples and oranges in a lot of cases. So I find it wise to kind of give them those that level of education. James, what would be the, kind of best steps for someone that is building a service business, managed service business, agency, whatever sector, to start this process of an exit and start lining up those pieces?
So firstly, getting personal clarity. So they're founder-led businesses is usually only a couple of people on the cap table, maybe some EMI options, but being really clear on what the number is. Forget the benchmarks, forget the big raises. Like, what is a number that's going to be meaningful to you? And then subtract all the sweat and tears you put into it, because the market's not going to value that. So getting really clear, because it may only be a couple of million, which is a lot of money, but it's a lot more achievable than someone's looking for a 50 million or whatever the number is. So I think get really clear on the number. Speak to the market and understand what multiples you are worth today, and just accept the fact that that's it. Have some conversations with acquirers, and understand the reality, because if you don't address that, you can't then plan ahead of how you're going to fill the gap, right? And the gaps needs to be filled one way or another. Is it scaling independently? Is it joining a group? And honestly, that process can take some founders a few years, because they're running the business. It's always like, oh, I've got a 5-year plan. We're going to sell in 5 years. And that's really a time frame they put out there, because it's far enough in the future to feel close, but it's not close enough to drive any action. So I would have that reality check. And then my personal recommendation would be to look at M&A, either M&A or having a conversation with people like yourselves who can give them a real honest set of options around the fundraising. And if they do fundraise, make sure that they get the right people to execute and de-risk it. A lot of times I've seen businesses do the raise and then underpay people, get sub-level management in, and then they spend 2-3 years and they say, oh, well, we didn't hit our targets. Well, you probably should have got better people in the first place who could execute. So, yeah.
Saying my cousin Jimmy's not good enough? No.
Yeah.
No, I totally agree. And I think that's very valuable. And James, for those that, are inspired by your story and or want to connect with you, what would be the best way for them to learn more about you and connect with you?
So yeah, just James Rose, Inflectiv Group on LinkedIn or inflectivgroup.com. Happy to connect and starting to post a bit more on there. So that's probably the best place.
And for those listening, if anyone wants an introduction to James, just ping me directly or leave a comment in the comments down below, and I'll be happy to help facilitate that introduction for you. James, I really appreciate you coming on here, sharing your story of kind of founder to operator, back to founder, and buying companies and this M&A journey that you're on. I look forward to following your journey, and thanks for coming on the show.
Thank you. Pleasure. Appreciate it. Thanks, Jason.
If you were inspired by today's episode, then go ahead, watch this next episode. Promise it's worth it. And if you really enjoyed this last episode and you want to connect with the guest I had on today, make sure to leave a comment down below telling me why you would like an intro to this guest, and I'll make it happen.